the segments that we operate in, which is basically to this bottom of the pyramid, unserved and underserved segment. So from a demand perspective, it continues to be strong. It's more on the supply side. There is still a lack of supply which is happening in this front. What has happened for Equitas is we ended up doing a highest ever quarterly disbursements of around 3,200 crores in the quarter. This was on the back of that Q2 of the last year. We had a high disbursement growth. Q3 we focused back on collections, wherein we redeployed the business and the other teams to focus on collections, which is where you saw a dip in disbursements. Q4 is when this pickup started again, and we are seeing that pickup has happened in a much more sustainable manner. Specifically so we continue to have a RSL or a restructured book of 1,500 crores. From that, what we have done is we have identified something called as a high risk RSL pool, which is around 37 crores. What we call as high risk is basically a customer who has not paid an EMI in Jan, Feb, and March, the last 3 months. So this is what we are calling it as an high risk. Surprisingly, 45% of this high risk portfolio has paid an EMI in the month of April, which means that this whole bucket of 37 crores need not flow into the NPA pool. There is resolutions and there is rollback which is happening, and customers are coming back and they are willing to pay. And this is also happening in the microfinance sector, which is historically unheard of. So that's a quick update on the RSL pool. The non-RSL credit cost is back at that one quarter level, which is typically the bank's historical levels. Quickly touching upon on the liability front, so the quarter saw improvement of 100 bips from last year, and the cost of funds came in at 6.2%. Deposits, which is both CASA and retail, continue to do well. Last year there was lower disbursements and lower advances growth, which is why we focused on retail deposits. This year we might see some inch up happening on the wholesale or bulk deposits. TPP income, which is basically a third party, which is insurance and mutual funds, they continue to do well. So other income continues to do well. Now lastly, before I hand it over to Rohit, on the regulatory front, 2 weeks back we received the NOC from RBI in terms of proceeding with the scheme of amalgamation that we have submitted. And couple of days back, we also the board also approved the stake sale of the subsidiary that we hold under the holding company, which is Equitas Technologies Private Limited. So from a procedural perspective, we are awaiting SEBI approval, which should come in 30 to 45 days from now. Post that, we will do the application to NCLT. NCLT will call for a shareholders meet. Once the shareholders meet is done, the board will proceed and call for a meeting to appoint the appointed date. This is broadly the steps or procedures which are pending for the reverse merger. From a timeline perspective, we are looking somewhere between December to March as the completion of this reverse merger. I'll now hand it over to Rohit, who can share insights on what's happening on the asset front on specific business. Over to you, sir.
Hi, good morning, everybody. So the last year has been a mixed year. The first quarter was obviously COVID impacted, and then disbursement started in the second year. So we had a 9.5% restructured book, quite large for our comfort. And we decided that some of our salespeople should be. Am I audible?
Yes, loud and clear.
Okay. So we said that that was creating some discomfort internally, and we deployed a large part of our sales team also to ensure that we have a grip on collections. In fact, sometime in October, we stopped disbursements completely to ensure that our 1 to 90 DPD comes down. June was the highest, And then from then on, we started seeing results. And by March, by February end, we were quite comfortable now that, collections are happening, collection efficiencies are improving. The market also was improving. The market had also opened up. And we redeployed all our sales people back into sales. So now the collection team does the collections and the sales team are back into sales. And the result has been that, March has been all around very good for all the businesses. Now, when you come to segment specific, the economy for our small business loans portfolio, we see a good demand at the ground level. Moreover, these are informal customers, hand-to-mouth customers, and they need to earn a living. So they need to operate their businesses to earn their daily livelihood. That seemed to be in full swing. On vehicles, where we have a large restructured book, we see a very strong demand coming back. Now, what has happened in vehicles is FY 18-19 was a year where peak sales had happened, 1 million vehicles. Post that, sales kept on dropping. It was a very bad scene for vehicles because a lot of factors combined to depress the sales. One was, the prices of vehicles had increased because pollution norms had changed from BS4 to BS6. So the prices went up. The government changed axle norms. So the same truck could carry a heavy load, created excess capacity. And then COVID also struck, fuel prices also went up. So combination of factors which affected the vehicle finance industry. Fortunately, in the last quarter, what we've seen is that the freight prices have increased to absorb fuel prices. So there's some free cash flow in the operator's hand. So this has spurred demand. So replacement demand, which was completely muted for the past 3-4 years, is coming back. So CV sales on a very strong growth path. So both ICRA and CRISIL are saying that in the next 3 years, CV sales will come back to the FY 18-19 levels. On the smaller CVs, which is on the LCV and the small commercial vehicle, that sector has been doing strong because e-commerce and logistics has picked up. So that segment is also doing pretty well. Another factor that is impacting is what has happened now is the replacement demand is primarily from the large fleet operators, people who own 100, 200, 300 vehicles. For the mid-size fleet operator, 5 to 10 vehicles or 10 to 15 vehicles, he's still scared of going for new vehicles. So he wants to buy old vehicles because freight prices, he's still not sure whether load availability will be the same as of now in the future. So, and the vehicle prices have also gone up drastically. So he is more interested in buying used vehicle. That has also spurred the used vehicle demand. Further, the load availability was completely impacted during COVID. Now there is good load available in the market. So fleet operators can get load both ways, and that has improved their free cash flows. So these are good signs, and we see that collection efficiency is coming back, resale values of CVs going up. So that gives us hope that, in the coming year, CV, the vehicle finance business, there will be good growth. On home loans, we had launched that product a year back. That's been doing pretty well. It is now in 35 branches. So we will scale up home loans substantially. We also want to get into a little bit into the formal lending to de-risk our portfolio, because currently we are more in the informal lending. So some of our lending also needs to shift to the formal customer. So affordable home loans is one step in that direction. We are also getting into formal LAP. So we're creating a vertical for formal LAP. In the vehicle finance space, we've launched used cars and we'll be scaling up used cars this year. This is primarily for income-based and self-use customers. So that is one product where we will see growth. On the LCV space, particularly, we have been focusing on small commercial vehicles, but we will also diversify into new ICVs and LCVs. That is one focus area for this year. On the used CV, we were primarily focusing on the 0 to 2 vehicle operator. Now we wish to focus also on the 2 to 5 and 5 to 10 vehicle operator. So these are some of the developments that have happened. Happy to take any questions that you have.
Thank you, Rohit, and thank you, Rahul. So, participants who wish to ask any questions can unmute their line and start asking questions. Okay, by the time participants gather their thought to ask question, I have one question. We have seen sharp rise in interest rate by the RBI. Even on the CRR part. So, from your perspective, how does this impact you? On the growth side or maybe on the liability side, if you can just throw some light on on your impact on the rising interest rates now.
So, as Rahul mentioned earlier, that we primarily focus on the underserved segment. The underserved segment is very huge. And if you look at our, presence, we are still not present in that depth across the country. We're still present only primarily in Tamil Nadu, a little bit in the west and north, but most of our business comes out of Tamil Nadu. So there's a humongous scope for us to increase growth through branches which are where the growth has not been so great, where the business volumes are low. So I don't think that the increase in CRR will impact us that badly because of these two reasons. One is sheer geographic distribution and our lending to the underserved customer, where not many people are focusing because there are execution challenges there.
Because just to add on to that, 15% of our book is what is linked to the repo rate. Rest is all small ticket and fixed rate loans in nature. So and our typical duration is roughly around 2.5 years. So as these loans get repaid, they would be redeployed at the current rate. Lastly, as far as the deposits are concerned, we will follow the market. So if our cost of funds goes up, we may look out. We may look to pass it on to the borrowers, trying to keep the impact broadly neutral at the bank level. Yeah.
Hi, sir. This is Rohit here from Sundaram Mutual Fund. I had two questions. One was on microfinance. Sir, now rural economy is looking okay. Monsoon predictions are good. Why are still we so cagey in growing the microfinance book?
So we have been one of the pioneers in this microfinance business. Been in this space for a very long time. We've seen all the ups and downs. We have seen demonetization and then this COVID. So see, this is a business which swings. It's like a pendulum. It's nothing like middle. Either it does very well or it does very badly. So sometime back, we had taken a call saying that microfinance will not exceed 15 to 20% of our book. And that is what we are following. So microfinance will grow, but it will grow only to that extent, 15 to 18, 19% of the book, because the book will grow.
Right, but there you can have a wider limit of 15 to 25 kind of a thing. So when you feel times are good, you can take it to 25 and then you can bring it down.
No, see, this business is such, Rohit, that this is unlike a retail business. See, a microfinance business, the way it operates basically, you have centers and in it operates on how the centers function. So and it's a cycle. I mean, you cannot step out of the cycle. So once you fund a center and you say the center the repayment is good, then it's a short duration loan. As the loan keeps running off, you have to keep giving them money, because basically this money is used for their business, and from that business they earn something. So it's a continuous cycle. You cannot step off the cycle. So it's not that you suddenly decide that yeah, we will reduce it to 15 or 12 or 10. We can do that. No, it's not. It's unlike any other retail business. So our comfort levels, we've seen a lot of microfinance across the country. So we feel that keeping the unsecured book at a level of 15 to 18% suits our risk appetite, to be very honest.
Fair enough, sir. And sir, on used CVs,
Yes.
till Q4 also, we have not seen any growth, any significant growth there. So do you see that changing going forward?
Yes. So as I said, the used CV, the game plan is, one is obviously focus on what we are focusing, which is the 0 to 2 vehicle operator. But we also need to now focus on the 2 to 5 vehicle, 5 to 10 vehicle operator. These are more stable operators who have contracts with the large fleet operators. There is a surety of load. They're credit tested customers. So you will definitely see a lot of growth on the used commercial vehicle portfolio.
And sir, you mentioned that you are looking to get into formal lending in home loans, formal lab, even in cars, you are getting into used cars. Will those impact our NIMs?
See, it won't impact our NIMs, because you have to get the product mix right. So the product mix, we already have high yield products. What we don't have is low yield products. So you look at used cars. The used cars, the completely informal segment is done at about 17 to 18%. And then, the formal segment starts at about 12, 13%. But it's a more stable portfolio. So it's not merely the yields, it's also the operating cost, the credit cost that impact the ROAs. So I think from that perspective, it is ROA neutral. It won't impact NIM so much.
Right.
And
So,
Rohit, just to add on to that, the formal prime or the prime home loan that we're doing, that's with a tie-up with HDFC Limited. So
That
that's
is
not
only
on
a
our
fee
books.
base. That's
Yeah,
not
yeah.
on our books. That's primarily to make our customers sticky. In the home loan segment, primarily we're on the affordable, which is better than the informal, completely informal book.
no, I understand that. So basically what you're saying is, even if NIMs are lower at ROA level, they will be fine.
Absolutely.
That's how to look at it?
Absolutely.
Okay. Thank you, sir.
Yes, sir. I have one question on the deposit side. I know you look at assets, but maybe Rahul may be able to answer that. Am I audible?
Yes.
Rahul?
Yes.
Yeah, thanks. So with considering that the deposit marketing is getting very, very competitive and liquidity is becoming tight, will we recalibrate our growth expectations based on deposit rate movement, or we are happy to borrow wholesale and fund a 20% plus growth number in an incremental basis? What are the thoughts over there?
Yeah, so a couple of things. Like if you just go back to Q4 of last year, we were 45 bulk and 55 retail. And last year we recalibrated and made it 80 retail and 20 bulk. And also the point to note is the whole of last year we reduced our rates on savings front 4 times. But we kept that 7% as a carrot which is intact. So we are just playing around with the grids internally. So today we offer 7% to a savings account between 5 lakh to 50 lakh as a balance. It used to be it used to start from 1 lakh to 1 crore also at some given point of time. So we'll recalibrate internally or within the grids. Last year loan growth was muted, which is why we didn't focus much on bulk or wholesale. This year, as and when the loan growth picks up, if liability is not able to catch up with the loan growth pace, we may look at tapping wholesale or bulk. But again, it's going to be very tactical in nature, or it's going to act as a balancing figure and not a full-fledged or a wholehearted strategy.
To add to what Rahul has said, see, we are one of the pioneers in the banking industry in sourcing deposits digitally. Even RBI has acknowledged that, and we have increased our ability to source deposits exponentially, and that is why you see that our CASA ratio is more than 50%. So with the current rate, the rate at which we are acquiring deposits month on month, I don't think that we would fall short on the liabilities side unless and until some extreme event happens in the market that there's absolutely no liquidity in the market or things extreme event. Otherwise, in the normal course, I think we are very good as of now. So I don't see a problem.
If you want to just put a number of the percentage of deposits sourced digitally, what would be that?
Rahul, can you give us the data?
No, so I'll tell you. So the last year we acquired 21 lakh accounts digitally. So if you ask that whether digitally sourced account have a very high balance, not today. As a percentage of CASA, digitally sourced accounts only form 7% of it. But this 7% used to be 1% a year before. So there is a customer life cycle management which happens. When you open it for the very first time, which is a half KYC account, you anyways can't have a balance above 1 lakh. Then it has to be converted to a full KYC. Then there is a call which goes, there is an RM which is assigned. Then the branch manager visits or the customer visits the branch. So as and when this cycle of events happen, we have seen that the balance starts moving from 3,000-4,000, which was initially, to 18,000-19,000 as and when things pick up. So today it only 6% of the total CASA, which used to be 1% a year before. So that's been the traction of how the deepening of the accounts have happened.
Yeah, thanks, Rahul. Yeah, over to you, Vikas.
Yeah, thanks. Dripta, you can unmute your line and ask question.
Thanks. Am I audible?
Yes.
Yes.
Yeah. So I recall on the result call you had said that you're looking at around a 30 to 35% advances growth this year. Could you tell us a little about how that would move across segments? What would drive this?
Yeah. So Dripta, the way, as you know, we have three main lines of business currently, which is the small business loans. Then we have vehicle finance, and the new business is the home loans business. Now, if I have to address on small business loans, as I said, small business loans, majority of our business today comes out of Tamil Nadu. Though we have 425 branches where small business loans are located, we are not there across the full range. We have about 829 touch points across the country where different branches are located. So all these businesses currently are not there in those branches. For instance, vehicle finance is only in 238, small business is in 425, home loans is only in 32 locations. So there is ample scope to go across to our own branches without increasing cost and source business. So one is, one aim is to go across, deepen our, take the advantage of geographies where we are present to source business. This is one. Secondly, if you look at, there's a strong demand in the small business loans. So since we had consciously not focused on growth last year, there is ample scope to grow that business, because it's a business to the informal customer. It is underserved. Not many people are there because of execution challenges. And the way, see why we are in this business is because of the microfinance portfolio. So when we started the microfinance business, and then we realized that a lot of these people took the money and used it to further themselves. So we saw them, going towards prosperity, increasing their businesses. See, somebody who was employed could rented a shop, started his own business, and then he or she could employ people in his business because the scale of that business grew. So they hired one person, but they also needed funds to expand their business. And that is how the small business got small business loan, SBL business had its origin there. So we understood that needs, and that is how it came into being. Now there's a huge, tremendous opportunity of cross sell where MF customers would be doing well, need money. So that is something that we have not tapped so far. Because in the COVID time, absolutely there was, there's lockdown and there was no possibility that we could have done. So that is one possibility. Second is, as I said, deepening geographies. Third is inherent growth itself, because the demand is high and the supply is less. So that's about small business loans. Secondly, in vehicle finance, we are primarily in the used 0 to 2 vehicle category. So now we are saying that we will also do 2 to 5 to 5 to 10 vehicle category. So we are expanding the product range itself. We are also increasing the number of branches. So we are present only in about 230 branches in vehicle finance. Then on LCVs, we are primarily in small commercial vehicles, which is the Tata Ace, the Ashok Leyland, those. We are not at all there in the 7-ton to 10-ton range. The Tata 407, Mahindra Pickup. So we are not there at all. And these are very good products with excellent repayment culture. So that is something that we will further expand. On used cars, we have a very low base. So we were hardly doing about 20-30 crores a month. We want to hit about 100 crores a month. So that is another possibility where, where we can expand. So that talks about the vehicle finance business. And in home loans, we have a book of about 600 crores as of March 22. This year, that book will grow to about 1,600 crores. We'll add about 1,000 crores of advances there. We were not there in formal lab. So we've created a new vertical in formal lab. So formal lab itself will give us another 500, 600 crores this year. So this is how, in granular, how the advances will grow for each business. And I hope I have answered your question.
Got it. Thank you. Secondly, on the restructured book, so you mentioned 1,500 crores, of which 37 crores is the high risk segment. In the rest, is there anything where you still have moratoriums running, or has billing started across the remaining restructured products?
Yeah. So the maximum morat that we gave was for 3 months. So the moratorium ended in September, and by December the entire pool had started billing. That is why we said Jan, Feb, March, how many customers were paying, how many customers are not paying, and that is how we arrived at that pool of 37 crores, because 611 crores out of 1,500 is in 1 to 90. Out of that, 37 crores worth of customers did not pay at all. So that's how, morat was only for 3 months, and the billing has started for the entire book.
Got it. Thank you. And could you just clarify what the provisions that you hold on the standard restructured advances are?
Rahul, can you give the data if you have?
Yeah, sure. So total provision that we have is 593 crores, which includes NPA provision of 358 crores and standard asset including restructured of 235 crores.
235.
Correct.
Okay, got it. Thank you. That's those are my questions.
Thank you.
Yeah, any other participants wish to ask question can unmute their line and ask, or can raise their hand?
Yeah, I have a
Hi.
question.
Sorry, Rahul, go ahead.
Yeah. So I have this question on this digital tie-ups with fintechs that Equitas has now. So in the past, some of the startups had like tie-ups with IDFC first, and then those tie-ups have gone. So who actually owns the customer? So how does it really pan out? That is, if these startups, maybe because of funding crunch or something else, they start moving out. So who is owning the customer?
See, as of now, on the asset side, we have no tie-ups with fintechs because as we have explored this, we have had discussions with many fintechs, and you are right. All these fintechs are in the market because of two things. One is they don't have the money to lend. Secondly, they have no collection capabilities. They can only probably acquire a customer. So on the asset side, we have not found much use for fintechs. I don't feel that fintechs can really add value to the business. They might only take our customers away.
Right.
Right. So consciously on the asset side, we have kept away from fintechs. But yes, we ourselves are doing a lot of development. Ourselves are doing a lot of development to ensure that in the next 1.5 years, we should be completely digital and we should be paperless. So that journey is on. Those investments are on the liability side. We do have a tie-up with NeoX to basically source accounts. That's all. I mean, there's no other tie-up to be very honest.
Just to add on to that, Rahul, so we have a tie-up with Neo, for example, wherein what they're pitching is basically so it's a wealth management platform wherein you buy stocks and mutual funds. So they're pitching Equitas savings account as a debt asset allocation of a 7% savings.
Okay.
So which is basically if you open it through them, you have a Equitas savings account. Now without Equitas, there's no savings account behind the partnership.
Right.
So if tomorrow Neo decides to cancel this partnership or due to some unforeseen situation something happens, you as a customer can call Equitas and you can continue doing the transactions, making the bank account operational, everything. So for example, if you're a customer who has opened a NeoX savings account, you get two sets of customer service option. One is you can call the Neo customer service, or second you can call the Equitas customer service. When you call us, we are not going to say that you are a NeoX customer, so please go and talk to them. You are my savings account customer, and the savings account is of Equitas. There's no other account in the background which is out there. But yeah, there is a high possibility anyone can leave, so no one is bound by it. If we don't feel that there's value in it, we can also terminate the relation. So just to give other perspective or thought processes, see, we have done tie-up with Neo, we have done tie-up with Grow, which is also another fintech. Neo tie-up has a end of period balance of somewhere around 400 crores. Grow has a balance of somewhere around only 8 crores. That's a massive difference. NeoX or Neo is focusing on top line and customer acquisition and increasing market share. Grow is focusing on increasing bottom line, and as a bank we are also focusing on increasing bottom line. So when you are in a partnership or in a tie-up where both the organizations are focusing on bottom line, it's not going to move the needle. So you need to have a partnership wherein one is ready to take that burn. Obviously Neo has the capital to do that. As an organization or as a bank, we are not going to burn money. So that's another thought process or different that is out there.
Also, what happens, Rahul, see, now all customers who've been sourced through Neo are Equitas bank customers, and we can sell them our products to make them stick.
Right.
So they become available to us to that extent. So on the asset side, the things become dangerous. So in the liability side, the things are very easy.
And lastly, Rahul, so Neo also has an existing relation running with other banks. So for example, there is something called as Neo Global, which they have a tie-up with State Bank of Mauritius in terms of offering a Forex card.
Right.
As an SFB, I can't do Forex. So I am limited by that and Neo is limited by that. So it's not a zero-sum game per se. So you'll have multiple vendors and multiple partners in the ecosystem.
Right. Thank you.
Yeah, Preeti, please go ahead. I mean,
Hi. You mentioned the percentage of your book that is variable rate. I missed that number.
15%.
On the asset side, 15% of your book is variable rate.
Correct.
And the remaining 85% is a fixed rate book, right?
Correct.
Yes.
Correct.
Okay, got it. All right, that's all. Thank you.
I think Preeti had a question.
Yes. Thank you. Thanks for the opportunity. So, sir, he alluded in the beginning that there's a large opportunity in terms of TAM, But if you see increasingly in the last 3 4 years, the focus of the large banks on smaller business loans has also gone up. So in the marketplace, how do we differentiate ourselves vis-a-vis these large banks? As this is one of the important segments for our business.
No, so Preeti, see what happened. We already have a 9,000 crore book in small business loans, right? And this is the current live book, which is about 2.5 lakh customers, and we have gone through that entire cycle. So what happens is, the entire credit appraisal mechanism, or the entire acquisition mechanisms, we don't acquire through DSAs. Even today in small business loans, about 92% of our book comes through referrals and direct and through our own in-house sourcing. So it's only about 8% of our book is acquired through intermediaries. So now this is an experience which is very difficult to replicate. So and let's accept one thing. See, in the financial services industry, I mean, there's nothing like any USP which can be a permanent USP for any bank. Anybody can learn anything. It's just the time. So, but we are ahead of others, and the way we are, the lot of things that we are trying to do to further, make things easy, make a customer experience easy for these customers, because we have a wealth of knowledge which we have acquired over the years. So yes, a lot of people, definitely that's how economics and industry works. And a lot of people will see that we are doing well with small business loans. A lot of people might want to enter that business, but there is a huge learning curve there. It is not like a formal customer. Lending to a formal customer has become very templated today. It's become a commoditized product. So it will take a lot of time for people to really understand and come into this underserved market. Secondly, the underserved market is very huge. I mean, even if 2-3 players come into the market today, it will take a long time for the demand to get exhausted. So the way we differentiate today is we are a small finance bank. We are truly doing inclusive banking, serving the underserved, serving the informal customers, and making them happy, seeing them, grow in prosperity. So that is how we are differentiating from the large banks.
Couple of more things, Preeti. So again, we have been doing this for last 10 years now, small business loans as a product. At least in the informal lab that we do, we still don't see a competition pressure on yield. We are not seeing large banks entering this 4-5 lakh ticket size as a product, because one, it's operationally challenging. You need a large fleet on street. Optically, your asset quality is going to look high. Like we still run on a 30-35% check bounce ratio. Will a large bank be in a position to have that optics? Maybe not. So we'll have to see that. And the wealth of data that we have is humongous. Like, for example, if we can tell you that Jersey cow milk vendor in a metro with 100 square feet shop will generate what kind of an income on a month. We have those insights, and it's coming from those historical data that we have. So that like Rohit said, it's going to take time to build that knowledge, and from a customer standpoint, it is on a first come first serve basis. They are not going to log into a policy bazaar or a bank bazaar and see which bank is offering me a better rate. It is who is coming and tapping the customer first and is taking it. And lastly, as a hook, what we have recently done is we have introduced something called as a merchant OD, wherein if the customer is in need of OD facility during a festive period or in terms of high demand period, he may be going to a NBFC and taking a term loan, which is not an ideal product. We are ready to offer a OD facility to that customer for that certain period, and that's a beneficial product. If we are having fintech talking about it, why can't we do that? So that's something that we've launched recently. We've done the pilot. The response has been phenomenal. We'll see how we can scale that up.
So this is what I didn't want to talk about, but Rahul has talked about it.
No, sir. We have spoken to the market. So yeah.
Okay.
Feel free.
So I'll just give you some stats. So we just did a scrub, and we found that there are 70,000 customers who are eligible for a merchant OD of about 2 lakhs to 5 lakhs. And this is all these customers have now a CIBIL score because they've been with us for a long time. And all these customers are from the small business loans category. So merchant OD is something that we have innovated. Now we need to scale it up. So that's another thing. But I thought, I didn't know whether Rahul had talked to you, so I didn't want to talk about it.
So thank you. Thanks for those insights. So just a follow up to this would be, because we are following this specific way of, acquisition. So will that bring challenges in terms of scalability? So yes, today we are close to 10,000 crores, but as we grow, going by this approach, would you think that would be a challenge?
So as I said, we are already on the path to digitization. So we are trying to make it so simple. For instance, this customer, these are all existing customers. So if I want to get the application form filled, I don't need to do anything. I just need to send a QR code. So he scans the QR code and automatically the application form is there. In terms of customer servicing, see, we have given our customers cards. So they don't have to do anything. They just have to scan the card and their last receipts are there. The amount schedule is there. So there are lots of stuff that we are doing to ensure that we stay ahead of the curve. The next 2 years, all these things will play out. And once we have done it with our customers, 70-80%, we'll talk actively about it and we'll showcase it also.
Got it, sir. Thank you. And thanks, Rahul. Thank you.
Thanks, Preeti. Anirban, you can go ahead and ask question.
Yeah, hi, sir. Thanks for the opportunity. Just one question. You mentioned some very interesting things about the kind of data that these scrubs throw up. So just one broader question in the context that the RBI is now increasingly, alarmed at what kind of data sharing goes on between fintechs and their lending partners. So what's your view on that? Should that change anything regarding what we have now that we also had a set of guidelines that say that such data sharing between a fintech sourcing partner and the bank should be very limited? So how are we looking at this situation?
No, so to be honest, that is why I said that on the asset side we have, or on the liability side, we have not shared data with any fintech. The types that we have on the liability side in fintech is primarily for acquiring accounts. It's not about sharing data. The type we have with HDFC is only about giving home loans to our customers. So there is no sharing of data anywhere, with any fintech. On the asset side, a lot of fintechs have approached us, but we have, as of now, kept away from fintechs. We do not have any FLDG tie-up with any fintech, primarily because we feel that if we share data, who owns the customer? Basically, who owns the customer? And we feel that we should own the customer because we can do a lot of stuff to that. And the customer's privacy is also protected. So as of now, we have taken the stand, but let us see what regulations, if regulations change, if the market changes. But as of now, we have taken this stand that we have not involved any fintechs on the asset side. We have not shared any of our data with any fintech.
Sure. No, my question was more in the context of, you mentioned the data point that you found there were 70,000 customers who could be given a 2 to 5 lakh OD limit.
So this is not, we did not share it with any fintech.
Okay.
We did a bureau scrub on our own customers.
Okay.
To find out what is their current situation. And since they are existing customers of ours, we already have a wealth of data on them on, what is their vintage with us, what is the kind of collateral that they have, what are the business that they are involved in, right? And when we acquired them, they were completely unbanked. Has the banking changed over the past 3-4 years? So that is the in-house data from which we have arrived at eligibility. We have not shared it with anybody else.
And this merchant OD as a product is not with a tie-up with anyone. It's our own product.
Our own product, our own teams going to meet our customers and giving the product to our own existing customers.
Great. Thank you, sir. Thanks. That's very clear.
Thanks, Anirban. Thanks.
Anyone who wish to ask question can unmute their line and ask, please. I have a question. So, I mean, yes, we have given an in-depth focus for the next 1 year. How the asset book is going to grow, but from a medium-term perspective, if you can just throw some light, which segment. I mean, how the change in asset is going to be over a medium term, and what impact of that could be there on the margins perspective.
No, so in the medium term, I don't think there will be an impact. In the medium term, you'll only see home loans going up. Home loans going up substantially. In the vehicle finance, used car going up substantially. But to compensate for any yield drop, the SBL is also expected to, planned to grow substantially. So I don't think in the medium term there will be any major impact from what we have stated.
So despite whatever the changes in the asset mix, you believe that you would be able to sustain your margin at the same level?
See, as I said, the margins are dependent on credit and OPEX. So the newer products, for instance, home loans, used car, have a lower OPEX, have a lower credit cost. So I don't think, the margins won't get impacted, or the ROIs won't get impacted.
Okay, got it. Yeah. Participants, any more questions from your end?
Yeah, hi, good morning. I just have one question. When we talk about the MFI book, but other than MFI, all the other segments that we lend into, like how are these customers sourced? Is it somewhere like where the MFIs are present, or it's different geography altogether?
No, it has different geographies. If, for instance, AP, Telangana, we have no MFIs, but we do have the rest of the businesses there. So it's not necessary where MFIs are there, but MFI is there in Tamil Nadu, Maharashtra, Gujarat, MP. So anyway, all the other businesses are also present there. But it's nothing to do. If you are asking me whether you'll operate wherever MFI branch is there, no, not necessarily.
Okay, no, so the sense I was trying to get is that if we have these MFI customers, at what level, so we won't be lending these categories to them, right? But otherwise also, like at what percentage of their household income we will be comfortable to lend? So just to give a sense where I'm coming from is that now, given the rising inflation and the disposable incomes coming down, like how do you see your lending strategy going ahead? Because they might be sourcing loans to multiple MFIs, but and through different categories of loan. But till what level are we comfortable of their credit exposure as a percentage of their household income?
So on the MFI piece side, the RBI has come up with new norms. Now there is no choice. The RBI has said very clearly that your FOIR has to be 50%. And the change that they have made is, earlier it was individual income, it's household income now. So you have to capture the household income. They have also increased the limit of the household income. So it's 3 lakhs now. So the household income and the FOIR has been clearly fixed, and it has to be captured in a format that RBI has given. So the entire industry is gearing up for those changes, and we already got the board to approve all the policies before the beginning of the year. So there's no choice. It's a 50% FOIR.
Right. So I get your point. But my question was around, so one is, what is their household income? And the other thing is that what is disposable income? Given rising inflation, the disposable income would have come down. So there is possibility that maybe over next 6 or 12 months, they might have less money left to pay the EMIs. So, I mean, are we going ahead and lending them through other categories, or is just staying MFI and then the other categories are differently placed? And at what level are we comfortable to keep the overall credit exposure?
Yeah, so we are comfortable with the 50% FOIR. Now, what really happens due to price rise is anybody's guess, right? If consumption does not get impacted, see, as I read in the papers, people are saying that customers are moving from large packs to small packs in case of FMCG. So, yeah, but will the overall consumption get impacted? I don't know. Obviously, if the industry consumption gets impacted, the industry will get impacted. I mean, if you know, Hindustan Lever sales itself come down, then obviously, you know, the whatever, I mean, everybody will get impacted to that extent. But if you are asking me that, you know, when a customer has a certain amount of disposable income and we have lent him something, 2-3 products, will you keep lending him more, or will you restrict? We will restrict definitely. We are not comfortable with the over-leveraged customer because it leads to delinquency later.
Right. Okay, got it. Thanks.
See, the scope to increase, Saili, the scope to increase the customer, get into new customers, new geographies is humongous for a small finance bank like us, because we are not present everywhere. We have not deepened our geographies other than Tamil Nadu everywhere. So that's a huge opportunity for us. Even we have not sold our own products to our own customers. So we have a huge liability base. So there also we have not even gone and sold products to those customers as of now. So there is a huge opportunity in both, in deepening geographies as well as selling to our own customers.
Okay, got it.
Yeah, we are almost at the end of our meeting time. So any last question from any participants? Yeah, I believe there are no further questions. So I think we can wrap up the meeting here. Thank you, Rohit. Thank you, Rahul, and thank you all the participants. Thank you so much.
Thank you. Thank you.
Thanks, Vikas, for having us.
Thank you.
Thank you.